Joint ventures involving non-UK companies can create complex CGT issues, including potential Section 13 attribution of gains to UK residents.
Imagine waking up, pouring yourself a morning cup of tea, and opening a brown envelope from HM Revenue and Customs. Inside, you find a staggering, eye-watering tax bill for the sale of an asset you didn't actually personally sell and for which you haven't received a single penny in your bank account. It sounds completely terrifying, doesn't it? But I promise you, for UK entrepreneurs involved in offshore joint ventures, this isn't a hypothetical horror story. This is a very real nightmare playing out for investors every single day.
£240,000. Just let that number sink in for a second. That right there is a real-life example of a sudden dry tax bill that was levied on a UK investor. Now, if you're wondering what a dry tax is, it means the tax liability is due immediately, even though you, the taxpayer, haven't seen any actual cash hit your personal bank account. It literally forces investors to scramble and find cash from their own private pockets to pay tax on purely paper profits. It is, without a doubt, one of the most massive, devastating blind spots for UK investors operating internationally today.
Hello and welcome to This Explainer. I'm here representing Pro Tax Accountant, or PTA as we're known. We're your trusted UK tax experts, and we are highly experienced in navigating this incredibly complex and, quite frankly, sometimes treacherous minefield of offshore tax legislation. Today, we aren't just going to show you how this hidden tax trap works. We're going to break it all down and walk you through exactly how to legally protect your hard-earned wealth and your joint venture investments.
Right, let's dive into part one, the offshore tax trap.
So where does this trap actually come from? Well, it stems from a piece of anti-avoidance legislation that was historically known as Section 13 and is now legislated as Section 3 of the Taxation of Chargeable Gains Act 1992. Originally, this was designed to stop UK residents from maliciously hiding their money in offshore tax havens. But over the years, its net has grown incredibly wide. The trigger for this legislation is something called a closed company. The best way to think about it is to ask yourself, if your offshore company were a UK resident, would it be controlled by 5 or fewer participators or by its directors? The harsh reality here is that almost all genuine, commercially motivated joint ventures between a small number of business partners will meet this exact definition, which drops them straight into HMRC's crosshairs.
Let's look at how this plays out in a typical offshore joint venture structure. Imagine we have a property holding company set up in the British Virgin Islands, or maybe Jersey. We have 3 UK investors who have pooled their resources together, and each of them holds around a third of the equity. Now, the absolute magic number for HM Revenue and Customs here is 25%, because every single investor in this specific scenario holds an interest that is greater than that 25% threshold. Every single one of them is highly exposed to this punitive legislation.
So what actually happens if this non-resident joint venture goes ahead and sells an asset? Let's say they sell off a piece of lucrative intellectual property, some commercial real estate, or even a subsidiary company, and they realize a chargeable gain. Well, HMRC does something quite extraordinary. They completely ignore the legal boundary of that offshore company. They pierce the corporate veil, extract that gain straight out of the offshore entity, and apportion it directly onto the personal UK tax returns of those participators. That limited liability protection you thought you had, it absolutely does not protect you from this specific tax charge.
Did you know? And please, if you take nothing else away from today, remember this vital insight. The tax is due on an arising basis. That means the tax charge hits you the very moment the offshore company disposes of the asset. HMRC completely ignores whether those proceeds are retained in the offshore bank account, whether you've reinvested the money into a brand new development project, or if the funds are legally locked up for years. HMRC wants their cut right now, which usually leaves the UK investor frantically scrambling to find the cash.
Okay, moving on to part 2, a real-world case study. Let's see this in action. Now, abstract tax laws can be incredibly tricky to get your head around. So let's imagine a tech startup joint venture based in Dubai, established by our 3 UK investors. Step 1 of HMRC's process, they calculate the gain on, let's say, a recently sold software patent, exactly as if that Dubai company were a UK resident paying UK corporation tax. Step 2, they aggressively trace the corporate family tree to identify every single participant, even the indirect ones who might be hidden further up the corporate chain. And finally, step 3, they mathematically allocate that gain based on your specific percentage of interest, applying what they like to call a just and reasonable adjustment if your ownership structure is particularly complex.
Let's put some hard numbers to this and look at the financial devastation this calculation can cause. Our Dubai joint venture realizes a total gain of £1 million from that software patent sale. UK investor A, who holds a third of the company, automatically gets £333,000 apportioned directly to them. Now, assuming they're a higher rate taxpayer under the current 2026/27 rates, they're facing a 24% capital gains tax. That results in an immediate personal tax bill of roughly £80,000. And remember that golden rule of dry tax we talked about earlier? Investor A has to pay this $80,000 right out of their own pocket, despite having received exactly zero cash from the Dubai entity.
Which brings us neatly to part 3, calculating apportioned gains and the looming threat of double taxation.
As if the dry tax wasn't bad enough. Without incredibly careful planning, the exact same economic gain is going to be taxed twice. Yes, you heard that right. You pay capital gains tax right now on the apportioned gain. Then, years down the line, when the company finally pays you a dividend or you sell your shares, HMRC taxes you all over again. Now, there is a statutory relief mechanism called Section 3C, which does offer a tax credit to prevent this double dipping. But, and this is a massive, unforgiving but, that relief is strictly limited to a 36-month window. Because most commercial joint ventures require capital to be locked up for 5 to 10 years just to fund their growth, claiming this relief is often commercially impossible. If you miss that 36-month window, you lose the relief entirely, and you pay tax twice, permanently.
Let's pivot slightly to part 4, statutory defenses and compliance.
So, it's not all doom and gloom. The legislation does actually provide 2 primary defenses under Section 3A. First up is the purpose test. For this, you must prove that avoiding UK tax wasn't the main purpose for setting up the offshore structure in the first place. But honestly, good luck convincing HMRC of that without an absolutely ironclad paper trail. Second, we have the genuine economic activity test. This means demonstrating that the offshore company is an active, trading business with real, local substance, rather than just a shiny brass plaque on a door in the Cayman Islands. Make no mistake about it, HMRC generally assumes you are guilty until proven innocent here. The burden of proof sits squarely on your shoulders to demonstrate this commercial reality. So, here is a professional tip straight from us at PTA on how to actually survive that economic activity test. You need absolute, rock-solid local substance. First, ensure a majority of your board consists of competent, independent foreign directors who genuinely understand the business. Second, hold all your board meetings physically outside the UK. Absolutely no dialing in on Zoom from your home office in London. Third, employ local staff directly on the ground. And crucially, you must document the commercial, non-tax rationale for your offshore structure at the very inception of the project. Creating a contemporaneous paper trail from day one is really your only reliable shield against a brutal HMRC inquiry.
Finally, part 5, protect your joint venture. Let's look at some actionable steps.
To wrap everything up today, these are the non-negotiable actionable steps every UK investor must take. First, meticulously review any offshore company interests you hold that are over 25% on an annual basis, just to monitor your exposure. Second, monitor the joint venture for any asset disposals every single accounting period. You really don't want to let a sudden, unexpected sale catch you off guard with a massive dry tax bill. Third, if it's commercially viable for your business, draft your JV agreements to mandate distributions within 36 months. This preserves your double taxation relief. And above all else, you absolutely must seek expert tax advice from specialists like us at PTA before you even draft the initial paperwork. Do not wait for that brown envelope to arrive on your doormat to discover you have a massive problem. Before we conclude today, just a quick but important note. This explainer is designed purely for educational purposes to highlight these critical tax risks. It doesn't constitute specific financial or tax advice for your unique individual situation. As you've seen, UK tax law is highly complex, it's very nuanced, and it's constantly evolving. So please always consult a professional regarding your specific circumstances. Which leaves me with one final, truly critical question for you to ponder today. If HMRC opened a Section 3 enquiry into your offshore joint venture tomorrow morning, would your corporate paperwork defend you, or would it condemn you to a catastrophic dry tax bill? If you have even a shadow of a doubt, please do not leave your wealth to chance.
Contact ProTax Accountant today for boasted expert advice tailored to you. You can easily reach us by phone on 07985689912. You can drop us an email at info@protaxaccountant.co.uk or just visit our website at www.protaxaccountant.co.uk. And hey, if you found this explainer valuable, please hit that subscribe button on the PTA YouTube channel for more essential tax insights. Thank you so much for joining me, and stay tax safe out there.